Fund 6 had incredibly high demand. We had 14 billion euros of first close demand against a 9 billion target and a 10.5 billion euro hard cap. So it was actually it took us quite by surprise, and then that all happened in 6 months. So in Fund 5, which was a 2008 vintage fund, the demand was strong early on when we started in late 2007, and of course petered out as the financial crisis hit. The difference between the two phases of fundraising, 2008, 2013, was really the perception of Europe. In 2008, Europe was not an issue, per se. At least they hadn't realized it yet. Of course, in 2013, Europe is much more of an issue. Is Europe going to survive? Is the euro going to survive? Will it break up? And what helped us quite a bit is that in 2012, when the central bank drew a line under the euro and said we're going to save it no matter what, sentiment started to tick up a little bit more. Well, I think there is a bit of a flight to quality. Of course, a lot of LPs were burned quite badly in the global financial crisis when the best private equity players did reasonably okay, but the worst did quite badly, also on a risk-adjusted and an index comparable basis. So I think there is a flight to quality right now, and that will tend to mean that the big players get a lot more money, and the small players will struggle a bit. But of course, there are some very, very good small players that have their following and can always raise money. But I think in general, the LPs are much more detail-oriented, want to inform themselves much better, and will tend to go with the more professional, big globalized firms. In terms of the total private equity business, if you look at it with the European business, it is about 20%. I think it will grow. I think we've opened new territory, Southeast Asia, for instance, having done deals in Malaysia and Indonesia and the Philippines, in addition to the traditional countries like Korea and Japan and now, of course, Greater China. Greater China, what we're seeing right now, which is quite encouraging, is control deals, actual buyouts, which we have done 2 this year, and we expect that phenomenon to continue. So I think Asia will grow as a percentage of our total private equity business. The European and U.S. part of it is not likely to grow dramatically, and it will continue to grow to maybe 25–30% of our total assets under management in the private equity part of the business. Well, this is one of our great strengths, frankly, because we have this very, very wide network of small, highly professional teams in a lot of places. We have almost 30 teams across the globe. So when a company in Asia is trying to do business in Europe or make an acquisition or in North America, they have a very, very ready hand and ready assistance from the offices in the network in Europe and North America. And that does happen in practice. I think take SPI, the business that we bought, the Philippine business. We actually did that as a joint deal between the Southeast Asia team and the U.S. team because they had quite a big business in the U.S. So I don't think there are that many firms that can easily and seamlessly do those sorts of deals that bring the Asian companies to the European and U.S. markets. And also on the M&A side, we of course it can be quite helpful to the Asian companies who are looking to buy businesses in Europe and North America.